Good morning. I am Jim O'Sullivan with SCORE. That is the National Organization of Volunteers that serve you as mentors and presenters at seminars like this in helping you start, grow, and improve your businesses. Today we have Jim Davis, who will be talking to you about understanding your financial statements and cash flows. At the end of that presentation, if you would put all your questions that you have down in the question box, Jim will go forward and help answer those questions. At the same time, at the end of the presentation, I will be releasing a poll, and there's 2 questions, and I certainly appreciate if you would answer those questions, because it would improve our webinar services to you. And with that introduction, I'll turn it over to Jim.
It's actually Mike Davis. Jim is a fellow SCORE executive, but we have too many Davises, and SCORE is the problem, but not a problem.
Okay.
So again, my name's Mike Davis, and I recently retired after 30-some years in financial services, where I spent my career analyzing stocks. And one way I did that was by going through financial statements. So I am not an accountant. I'm not trying to make you an accountant. The goal of this workshop is to give you some tidbits about basic financial statements and cash management, so that you're not petrified when you have a business or want to buy a business and someone says, "Here are my financials," that you don't shudder. So I appreciate you being here. And also, this is very important for disaster preparedness. In fact, one thing I would encourage each and all of you to do is go to our website, houston.score.org, and click on Browse the Library. And there is tons of great information if you have not done that. But on the lower right side, you will see a tab or see a link that says Emergency Preparedness. And you should click on that, and talks about things that you need to do in case you ever want to apply for the SBA, heaven forbid, for disaster loan. And I know hurricane season technically ends in 2 weeks, and you think it'll never happen to you, but it doesn't have to be a hurricane. It could be some other disaster. So we really believe you need to do disaster preparedness, and you need to keep records backed up on a timely basis, not do it once every 10 years, because if something happens, you won't have the information you need. So with that, we're going to go forward. This is a sort of a dated but standard SCORE presentation. We're actually going to skip a few slides, and then I'll take questions at the end. So we're going to talk about cash and then the basics of financial statements. So cash management, what does that refer to? Well, obviously the handling and management of cash, because cash is the lifeblood of our business. We need cash to purchase products and services from our vendors to make our product. We need cash flow to pay our suppliers and our employees. We need cash to buy equipment, to do whatever service or product we're providing. Also, if we have more cash, we can get financing at a better term. And so cash obviously is the lifeblood of our business. Also, we think a budget's very important, and we'll talk about that. And it's also important to collect payables on time and receivables. In other words, if you sell me something, but I don't pay for it in a year, that's not good. I mean, you want to make sure you get paid in a timely manner, because otherwise that money is going to come out of your pocket. And then negotiating expenses. We'll talk about that a little more later. Again, cash management, sort of related to what I just said. Obviously, bad cash management is people don't want to work for business where they're not paid on time, or they're worried about the business going out of business. It's not good for morale. The bank gets nervous. Also, customers don't want to buy from you. It's one thing if I'm buying something for you today and the business is over, but I don't want to sign a 6-month contract with you if I think you may go out of business, even if your product is better or even cheaper than the competition. So cash management is very important, let alone the stress it causes by having cash issues. So managing your money, and some of this is applicable to you personally. Keep records, again, sort of obvious. I mean, just don't throw a bunch of receipts in a drawer and say, "Oh, I'll look at it in 6 months," because then 6 months later, you'll look at it 6 months again, and that's not going to work. You want to establish some sort of consistent procedures that, maybe once a week, twice a week, you're going to go through your expenses, update your ledger and accounting records, and just basically have some sort of system. And again, we reiterate talking about conserving cash. Learning to read financial statements, as I say, that is one of the key highlights of this workshop. Including with that, we'll talk about a cash flow statement and doing a cash flow projection. I personally believe, cash flow is the lifeblood of a business, and that's just my opinion. And I love telling the story that And I tell us every time I give this workshop that when SCORE was open for the offices, I would volunteer in the main office on Monday and I'd go work out before I would go to SCORE. And I would stop at McDonald's and I would go get 2 Egg McMuffins. And imagine if I walked into McDonald's and said, I want 2 Egg McMuffins and my business does $100,000 in sales. The lady would say, that's great, but how are you going to pay for these Egg McMuffins? Well, my business generates 50,000 in net income. Well, great. How are you going to pay for these Egg McMuffins? My business generated $10,000 in cash, and here's cash. So that's the reason I believe that cash is the most important, and we'll talk more about that. But I actually got into a somewhat, vigorous discussion with someone from a bank, one of the, let's say, the sponsors of SCORE. He thought that, revenues are most important. Well, they're all important, but I just believe cash is really important because without cash, you can't do anything. Creating records. Obviously, it's important to create records. A journal is just the initial entry. If I decide to start a business today and I drive 20 miles to go see a SCORE mentor, if the office were open, I could actually write off that mileage. And if I had to pay for parking, which you did not at the SCORE office, I could actually have that expense. So my initial journal would say November 5th, X number of miles, so much per mile, and then parking, because I'd be able to reimburse those expenses later on. And the journal is basically developed into a ledger. And again, I'm not trying to make you accountants, but that's the old debits and credits. But you will need someone to help you with your accounting, whether it be a bookkeeper or some financial type person. You could either do it yourself or you could outsource. There are a lot of small firms that do sort of outsourcing for businesses if you're a 1 or 2 person business where you don't have the skills or the time to do that. But you do need someone to do that. You can also use accounting software. QuickBooks is what we recommend a lot. And actually, we've given a lot of workshops and we'll continue to give workshops on how to use QuickBooks. Cash or accrual basis. What does that mean? Again, I'm not going to make you an accountant, but most businesses use accrual accounting versus cash accounting. An example is if we have a water business and I sell Walmart 1 million bottles of water for $1 a bottle, it's fancy water. I know Walmart's good for it. Under a cash basis, I recognize that revenue, in other words, those sales when Walmart pays me. Under an accrual basis is once Walmart signs for the water, it's theirs, and I recognize the revenue. Most businesses do accrual, so I wouldn't worry about that too much. Chart of accounts refers to accounts that are unique to your business, and we'll talk about some examples later. Again, more comments about establishing procedures. The reason you want to do this is to make things easier, minimize the chances of fraud, and just cut losses. So you do want some procedures in place. And one thing that we strongly recommend, and I noticed as a SCORE mentor, is one of the most common things that people do not have when they have a business already is open a separate bank business checking account. You don't want to run your business expenses through your personal checking account. Yes, if someone ever asks you questions, it may be difficult. You may be able to find them if it's in your personal account, but it's a lot easier if you have a separate business bank account. And I understand there may be some fees to do that. Depends. Go to some bank or some bank you have a personal relationship with and see if they will let you have a business bank account from either a very low minimum balance or no fees. Another thing is separate sales tax receipts. If you're selling a product or service where you collect sales tax, remember that money is not your money. That is the state of Texas's money. And as such, yes, you keep that cash, but you may say, oh, I have $10,000 in my business checking account. Well, that's great. But if you owe the state of Texas $12,000, one, you're in trouble, or even $9,000, you need to remember that you have only $1,000 is yours. So make sure that you don't necessarily need it in a separate account, but you need to make sure that you understand and are able to separate how much of that cash is sales tax versus your cash, because you will need to pay that to the state, I believe, quarterly or semi-annually. Reconcile your bank account monthly. You should actually do this now. So no different than personally, we recommend you do that. Then it says owners should manage cash personally on a daily or weekly basis. I guess it depends on the size of the business. If you have 50 employees, I'm not sure the owner needs to do that. Depends on, and I realize most of you probably do not have 50-person businesses, but you just need some sort of procedure in place where you're involved. And more importantly, if you owned a business, you would not want to hire me, even though I consider myself trustworthy, to authorize the approval, to place orders from suppliers, authorize the payment to those suppliers, write the checks to the suppliers, and have access to the checking account. In other words, you would not want one person to do all of those things. You want some method where you can do checks and balances, where you as a business owner could check up on the person, or maybe if you have several employees, you have one person, actually place the orders, another person approve the orders, another person actually write the checks, because that's the way you would minimize chances for fraud. And then information systems really refers to, accounting software. And again, the key is to have financial statements, and we'll talk more about that later. Bookkeeping. So bookkeeping, and we actually had a very good workshop on bookkeeping earlier this week, is basically how we keep track of all our transactions. It's just, as simple as that. The products we ship or the services we deliver, and of course we have expenses for materials, for employees, suppliers, etc. So we just need to keep track of all of that. This slide we're going to skip. Conserve cash. I mean, yes, you want to have as little cash in the business as you can. You don't want to have a business that requires a lot of cash, because you're going to have to come up with that cash. So where it makes sense, try to use personal items. Now, maybe if you have to, have to deliver stuff, you could use your personal vehicle, or you may, be able to work out of home, etc. But be aware, for example, if you have a business that requires a delivery and you're using your personal car, you better check your car insurance policy, because heaven forbid you have an accident, you would not want to find out your policy says this policy is only for personal use, not for commercial use, and therefore the policy is void. So, but otherwise it makes sense to use personal items. And, cell phone's a great example where a lot of us, use our cell phone for work that we also use personally. Use the garage as a warehouse. If you're going to buy equipment or furniture, you don't need brand new equipment necessarily. You can save a lot of money by buying used. Lease space instead of build. Again, I think that's obvious. Most of us starting businesses are not going to go borrow money to buy a big building. We would lease something, have the lessor pay for the build out. That depends on, and negotiate 4 months free rent. Well, we always have that in the slides. And my answer is you got to be realistic. I live close to Memorial City Mall, and I noticed quite a few tenants have moved out. So I think if you wanted to open a retail store in this difficult environment, but again, I'm not saying you can't do that. If you went to the landlord and said, well, this space has been vacant for a year, I want several months free rent or low rent initially, then it builds up thereafter until my business gets going, and that makes sense. If you go to Houston Galleria and say, I want the space right next to Neiman Marcus and Tiffany, which has only been empty for 2 weeks, and I want free months, they're free rent, they're going to laugh at you. So you got to be realistic in terms of know what your negotiating power is. But there's never any downside from asking. They may laugh at you, they may not take you seriously, but still, you want to try and see if you can get some advantages when you initially start your business to conserve cash. So again, financial statements. So why do we care about financial statements? An analogy I use is once a year, I go to the doctor and I get a physical where he takes my blood pressure, takes my blood, measures my cholesterol, does all sorts of measurements, wants to know the health and well-being of me as a human being. Financial statements give us the health and the well-being of our business. They tell us how we're doing. They tell us what kind of shape we're in. They also let us keep score. We'll talk more about that later. But we obviously want to know how we're doing, and financial statements do that. And also help us make better decisions about terms of how we run our business. Do we need to expand? Do we need to add a new product? Do we need to change our pricing? So there's 3 basic financial statements: income statement, balance sheet, and cash flow. And again, we'll talk more about these in greater detail in a minute, but these are all driven by orders and activity. And one thing you'll notice is an arrow that goes through all the boxes because they're all intertwined. Very often when something changes on the income statement, it affects the balance sheet. In other words, if you sell a product or service, you're going to generate revenue on the income statement. You're also likely to have cash or need to buy supplies or pay people for services, and that'll generate cash. So they're very much intertwined. So again, balance sheet, income statement, sources and uses in cash, they're historical presentations, and we'll talk more about that. And then there's something called GAAP. And while GAAP is a store in your local mall, GAAP from the financial standpoint, what that really means is everyone is on the same rules. Like I like watching football, and imagine if I was watching one game and they said a first down is 10 yards and you get 4 downs to do it, and you get 25 seconds per play. And then the next channel, I go to a different game and they say, well, a first down is 8 yards. You only get 3 downs and you get 50 seconds to do it. So GAAP basically says that everyone is going to use the same rules and regulations in preparing balance sheet, income statement, et cetera. So if you show me your statements, I know they're done using GAAP, that I understand the basic rules. And more importantly, if you're looking at someone else's statements, you know that they're done under similar rules. And that makes it a lot easier to evaluate, the information to see, how beneficial it is. And so why do we do financial statements? We do it, one, because we're the owner of the business. We want to know what's going on, but we may have people that own part of our business. They want to know what's going on. And I guarantee you, a bank that has loaned us money, they want to know how we're doing because they want to know they're going to be able to get their money back. So again, financial statements is the way we measure the health of a business. So we're going to skip this slide. We're going to skip this slide. And working capital. Actually, we're going to talk about that in a second. So here is a balance sheet, a sample balance sheet, obviously dated, but the date doesn't matter. But the way to view a balance sheet is to view, for those of you old enough to remember, the old Polaroid instant camera or land camera where you would take a picture and out came a sticky, gooey picture. And then over time it developed. This is a snapshot at a given instant. So technically, this slide should not only say 12/31/2001, it should tell you the time of day. Usually it's the end of business that day. So we would assume this slide is at the end of business on December 31st, 2011. Why does it matter what time? Because on the last day of the year for this business, transactions probably took place, so it changed. So balance sheet is a snapshot of our assets and our liabilities at a given instant. So why is it even called a balance sheet? That's because the assets, the left-hand side, always equals the right-hand side, which is liabilities and owner's equity. Assets is simply everything we own. In this case, it's cash, it's money people owe us, it's inventory. It's a pickup truck we have against what we owe. We owe people money. We owe some taxes. We owe the bank. So assets minus liabilities, what's left over is owner's equity, which is sort of it's also called the net worth of the business from an accounting standpoint. So these two always equal. And I know I've said this 3 times, but I always love telling the story. Ages ago when I was in business school, before probably many of you were born, I had an accounting class and the teacher gave us a bunch of categories and said, construct a balance sheet. And as usual, I finished my exam early and I didn't know my balance sheet was right, but I knew my balance sheet balanced. My assets equaled my liabilities and equity. And then a bunch of us went to lunch afterwards and one student said he turned his exam in early, even though his balance sheet didn't balance. I'm thinking, you fool, you know it's not right. You should spend a few more minutes trying to figure out why it doesn't balance. So the reason it's called a balance sheet is because assets equal liabilities plus equity. So let's talk what's on this balance sheet. So on the upper left, we see current assets. Current assets are assets that are projected to be equivalent to cash within 1 year. Well, cash is already cash. Receivables, money that our customers owe us, we sure hope to get it paid within 1 year. And inventory, we hope to sell our inventory within 1 year. So those are classified as current assets, items that will be converted to cash within 1 year. And then we have items that we own that have value that will not be converted to cash. If we have fixtures in our store or equipment in our facility or a pickup truck we own, those will not be converted to cash. Hence, they're not current assets. So that's the list of all the things we own on the left-hand side. It happens to total 71,215. On the right-hand side are current liabilities. Those are things that we owe. In other words, money we owe to people or organizations within 1 year. So accounts payable means we bought some supplies from a supplier. They want to get paid within a year. Taxes, we got to pay our taxes within a year. That's why it says bank debt payable within 1 year, because in order to be a current liability, it's got to be within 1 year. So those are our total current liabilities. And then the rest of the bank note beyond 1 year is the $30,000. So there's a bank note for $37,500 with $7,500 due within 1 year. So all the liabilities total $49,650. So the assets minus the liabilities are the owner's equity. So $71,215. Does that mean your business is worth $71,215? It's possible. It's possible it's worth more. It's likely it's worth more. It might be worth less, but that's sort of a reference point. So again, a balance sheet is a snapshot of our assets minus our liabilities at a given instant. And we'll talk a little bit more about that in a second, but let's talk about working capital. So we just already talked about the difference between current and long-term assets. Well, working capital, as the third bullet says, is strictly current assets minus current liabilities. It's a term people use when looking at balance sheets. There's no right or wrong number in terms of what's the right amount of working capital. But working capital, I view, as the grease to run your business day to day, to let the machinery run day to day, because you need capital to pay your employees, to pay the rent, to pay suppliers potentially, especially before revenues come in. So that's just an accounting standpoint, accounting term to measure current assets minus current liabilities. And again, there is no right or wrong number. So again, here's a balance sheet. Now, to me, what I find a balance sheet's really helpful is, yes, looking at a balance sheet at a specific instant, and we tend to look at it at the end of the week, the end of the month, the end of the quarter, or the end of the year, but also compare it to a prior time frame. In other words, if in this case, we're looking at the balance sheet at 2000, we'll call it 2011, 2012, and 2013. And in this case, while the date's not given, it would actually be the same date. So it would be December 31st, 2011, 12, and 13. And this, by doing a comparative balance sheet, you can look and see, well, gee, my cash went up, fourfold. My receivables went up. My inventory didn't go up that much, which means a common question you should always ask on financial statements is why? Why did something change over time? The answer will give you insight into your business. And again, there's no right or wrong number. There's no right or wrong number in what the inventory should be in 2013. But if you look at it over time, it'll give you some insight. If your inventory is building very fast, that would make me nervous if it's growing faster than sales, because maybe you have too much raw material and you're not selling the stuff enough. The same with other categories on the right-hand side. So a comparative balance sheet is very helpful in terms of talking about trends, and it also helps to compare at the same time frame, even though you don't have to. If we owned an ice cream business and if we compared the balance sheet at the end of June versus the end of December, there'd be a big difference. Even in Texas, you're probably going to sell a lot more ice cream at the end of June. You probably need more inventory. You may need more cash. You may have less cash because you have more inventory. So it helps to compare at a similar time frame. In other words, you would not want to compare December 31st to June 14th. I mean, you can, but it may not be as meaningful. Another way to look at balance sheet is look at percentages. So we're here, cash went from 6% of assets on end of 2011 to 12%. Again, I'm not saying that's good or bad, but the question you can say is, okay, my cash is growing. That's good. That means I'm generating a lot of profits. My inventory, also went up as a percentage. My fixed assets went down, which in some ways is not surprising. As you grow your business, you could use one piece of machinery more efficiently. So just another way to look at comparative balance sheets. While balance sheets are helpful, looking at them over time, especially on the same date, provides a lot of information. So cash, do you have enough cash to cover payments and reserve? Only time will tell, but that also comes into a cash flow forecast that we'll talk about later, because remember, you may have to pay for some things before you start receiving capital. Accounts receivable, again, people aren't going to pay you right away for the product or service, so you need to have capital. Inventory, strive to keep it to a minimum. Yes, I mean, ideally you don't want too much inventory, but you got to make sure you have enough inventory. I recently bought 2 new computers. It was in August, and the reason I know it was August was it was back to school, and I went to Best Buy, and I wanted to buy some supplies to go with my computer. And they said, we are totally sold out of what I wanted because of back to school. Well, there's a case where not having enough inventory actually cost them lost sales. They had to go to Amazon and buy it. So you want inventory, you don't want too much inventory, but you want to make sure you have enough inventory that when your customers call and want your product, you're able to deliver that product in a reasonable time frame. Balance your requirement of fixed assets efficiently. Again, you want it, you want, if business picks up on a short time, you won't want to go double your capacity of your factory and then find out there was a short-term blip because of COVID and a month later it went away. So you just need to, think wisely before you add, spend money on fixed assets, which refers to equipment and machinery and buildings, et cetera. Accounts payable. In other words, if you owe me money because you bought from me, I say, well, you have 90 days to pay. Well, you should pay in day 89 unless I give you some incentive to pay sooner. No reason for you to pay sooner. Payroll. I mean, hire the lowest number of employees. That makes sense. Sometimes you could use temporary staff. A lot of businesses do use what's called contract employees. They're actually not employees of the business. They're contract. You pay them a fixed amount and then, on a temporary basis, and therefore you could hire them or let them go as appropriate, which is similar to temporary staff. Income statement accounts. These are just some categories about income statements we'll talk about. I'll show an example. So here's a sample income statement. And one way an income statement differs very much from a balance sheet is a balance sheet, again, is a snapshot at one instant. An income statement is over a period of time. It could be a day, it could be a week, it could be a month, it could be a year. So these two income statements are for a given year, 2010 and 2011. I would say you would want income statements, if you look at them, to be covering a reasonable time frame. If you do one day, I mean, what if you cut lawns and it rains that day? You're going to have no revenue. That means your business is losing money. Well, that doesn't mean your business is going to lose money. It just means you're looking at it at too short term of a time frame. So here we have income statements for 2 years. Again, it's already comparative, which is good, 2010 and 11. And the first category is revenue. We do get revenue by selling a product or service. So in this case, revenues grew nicely. And then we have cost of sales, variable cost. Let's go back to bottled water. So if Walmart says they want 20,000 bottles of water versus 10,000 bottles, my variable costs are going to go up. I'm going to need 20,000 empty plastic bottles. I'm going to need 20,000 labels. I'm going to need 20,000 bottle caps. I'm going to need more labor to produce those 20,000 bottles of water. So those cost of sales fluctuate based on revenues. They go up and down based on revenues. More revenues, more expenses. But as you'll notice here, even though expenses have gone up, my gross profit as a percentage of sales has gone up, meaning I am getting some economies of scale. I am getting some benefits by the fact I'm making a lot more bottles. So the fact that revenues grew nicely, my profit margins went up. Now we have fixed expenses. Office rent's a great example. You may rent a facility and let's say you're paying $1,000 a month. That expense is fixed whether you have $1 in revenue or $1 million in revenues. It is fixed. Now in this case, office staff and rent, it went up. I assume that's because of the office staff. They must have hired more people. But a lot of those expenses are fixed. Taxes, utilities, depreciation. These are expenses that do not fluctuate based on your sales. So here's our sales went up nicely and the fixed expenses only went up a little bit, only went up $5,000, which is one reason the business went from a loss in 2010 to a profit in 2011. And again, this is, these are fictitious numbers for a fictitious business, but they show the benefits of leverage. And you'll also notice that net income as a percentage of sales went from negative, you were losing roughly 10 cents on every dollar of sales, to actually making 7 cents on every dollar of sales between one year to the next, which is the very big swing. So again, an income statement covers a specified period of time, and it makes sense to compare apples to apples. Again, going back to my ice cream example, if you compared sales in December versus June for ice cream, well, December sales may be down, but that doesn't mean your business isn't doing well. You should compare December to the prior December. So here we also could look at income statement as a percent of sales. And so on the top, we have 3 different years income statements. At the bottom, we're looking at percentage, and you see the gross profit actually went down a little bit, and fixed expenses went down. So let's talk about gross profit going down. And people ask sometimes, what's the proper profit percentage? And the answer is there is no right number. Just because gross profit went down, that doesn't mean your business is not going well. If we're selling bottled water, maybe we have traditional plain water and flavored water. Maybe for whatever reason, flavored water has lower margins. But if Walmart says they want a lot more flavored water, you're not going to say to Walmart, oh, I can't sell you that. My margins are going down. As long as you're making money on your product or service, it's okay if you sell an item at a lower margin. The question you should ask your financial person, whether it be your bookkeeper, accountant, or even a SCORE mentor, is, why is my gross profit going down? Why are net income going up as a percentage of sales? So in this example, we could see over the 3 years, not only did sales grow, but net income as a percentage, doubled, which is great. We're going to skip this slide. So cash flow statements. Like I say, I believe cash flow is the lifeblood of every business because it really, drives, our day-to-day operations. It provides the grease to keep the gears running appropriately. So we get cash flow from operations. What does that mean? That is cash from the running of our business versus cash flow from investing and financing means either I get a loan from the bank or I get some investors to put some money in my company to buy in part of the company. So those are the major sources of cash flow. And then what's interesting about cash flow is we have non-cash expenses. Depreciation is the most common non-cash expense. So what does it actually mean to be a non-cash expense? And then the analogy I use is if your business bought a car and then you drove it off the dealer a lot, and technically a week later, you took it back to the dealer, they'd say, oh, it's worth less than you paid for it. That would not surprise any of us. Well, that car has gone down in value. That car has depreciated, but not $1 left your wallet. So it's a non-cash expense. So accounting lets us actually take an expense for something that does not, take cash out of our pocket, which actually is a good benefit because it means we have lower income and therefore we pay lower taxes. So again, cash flow from operations comes in from selling items, and cash obviously goes out. We have to pay suppliers, et cetera. And then, investors would be either buying stock in your business or by, loaning you money. And financing, and the ways you raise money for your business could either be through selling stock, as I said, or borrowing money. And stockholders, if cash is there, do get dividends. And people that borrow money or loan you money do get interest. So sources and uses of cash. This is a theoretical example where, we had cash to begin the year, and then here's the cash that came in. We had net income, and then we added back to depreciation, but then we had to pay for payable, and then uses of cash we had to pay for receivables. I mean, we had receivables, we had inventories, we had to pay for, we bought some new equipment, and then we had to repay part of our bank loan. So that was the cash at the end of the year. And what's interesting, and this slide I think is really helpful, is there's a big difference between cash and net income. And I'll go to my Walmart example again, is let's say you started a business today and tomorrow you sold 1 million bottles of water to Walmart, and $1 a bottle, you have $1 million in revenue, but you won't have any cash in the door. So you may have nice taxable income, but the checkbook's not going to change till Walmart starts paying you. So that's why, we think cash is really important. So here at the beginning of this business, the first year, you had no cash. Well, you put $20,000 in on your own. You got a loan from the bank for $40,000. You generated sales of $68,000. And then of course, sales tax is separate. That's not your cash, but it is, you actually physically have the cash, but the cash is the state. So you want to separate that. So that's the cash that you received, less all the cash you had to pay for. You had to pay for your suppliers. You had some advertising, you had utilities. You had to pay back part of your loan. So in this case, the cash received meaningfully exceeds, the cash out. Therefore, you generate a nice cash balance at the end of the year, despite the fact that business only generated $3,552 in net income. So again, cash versus net income is very different, but cash is what makes the world go around. So cash flow forecast, we at SCORE believe every business, whether it be ongoing business or startup business, needs a month by month cash flow forecast. And I think I was pretty emphatic on that, and that was intentional. Now you may say, I don't know how to do that. Well, that one, we can help you. That's one of our expertise. And we have a lot of good information on our website. In fact, again, houston.score.org, I would encourage you to browse the library. There is actually an Excel spreadsheet of a cash flow forecast there with a lot of categories. They all may not apply to you, but it's a good start. But when you do a cash flow forecast, you need to take into account two basic things when you're starting. One, you're going to have some startup cost. In this example, there's $115,000 of startup cost. These are one-time costs that you'll incur, and you will need cash to do that. It could be legal fees, could be accounting fees, or to down payment. If you're going to rent an office somewhere, they may want some money. So you will have one-time expenses. And in this case, there was $115,000 of startup cost, but we actually raised $130,000, $100,000 from a bank, and you put in $30,000. So you had $15,000 after the startup expenses. And then in month one, you estimate your cash flow. You estimate sales of 15,000, then cost of goods sold, which we said earlier fluctuates based on how much your revenues are. Then you have other expenses, and then you have your pre-tax profit, and then your cash flow. So the big question people say is, well, how do I estimate sales? And the answer is, it's tough. But the key thing is not so much a bank's going to say to you, where's the where did 15,000 come from? That's wrong. They're going to say, where did it come from? Explain to me. And the answer you should give is, well, I know I sell my bottle of water for $1,000, for $1 bottle, not $1,000 a bottle, $1 bottle. I believe I can sell 15,000 bottles because I have capacity to produce 20,000 a month, and I'll be able to do that right away. You just need to have some idea where the number came from. And why did you assume 10,000 gross profit? Well, I know from my experience in the water business, you get a 66% gross margin. So you just need to be able to have some logical reason why, because frankly, the numbers you put down, they're not going to be right, but you just want to have some idea what your cash flow is going to look like, because most businesses, even if they make money at the end of the first year, do consume cash the first few months. So not only do you need money to cover the 115,000 in startup costs, but you need money to cover the initial month's cash outlay before you start generating positive cash flow, until Walmart starts sending you the check for the 1 million bottles of water you sold them. So a cash flow forecast is very important to do. And that's why we recommend by month, because you may, like I say, be cash flow positive at the end of 6 months or a year, but that doesn't mean you'll be cash flow positive every month during that time frame. So let's talk a little bit more, about the numbers. And here, this talks about some ratios we'll talk about a little bit. Break-even point is the sales level required to cover fixed costs. In other words, how much sales do I need to cover my basic cost? We at SCORE can help you do that. And we're going to go on from this slide. So variance analysis, we talked a little bit before about budgeting. So again, if you have a cash flow forecast that's somewhat driven by your business plan forecast, you must have some idea what kind of sales you're going to do in the first 6 months. So here's a business that has projected sales, cost of sales, et cetera, and then versus the actual. And it's very good to go back and look, well, how did what I projected versus what actually happened? How did it come out? So in this case, sales were a little bit less, gross profit was less, yet net income was a lot less. So that's why you always want to ask yourself why. And it's the way you keep score. You go to the ball game, you want to know the players, you want to know how the game's going. This is how we keep track of the players in the ball game and see how things are going. And maybe you were just new to making projections, so you weren't able to be as accurate as you want. But it's very good to be able to go back and look and see, okay, why do I think my sales were a few $1,000s less? Why was my gross profit down by this amount? Rent was the same, et cetera. Just constantly want to ask yourself why, and variance analysis is a good way to do that. So let's talk a little bit more about financial statement analysis. We have these financial statements, and these are some categories that we think financial statements are important. So market prospects, it's obviously easier to do well in a business when this business is doing well. For example, if you came to SCORE and said, I want to start a business that serves the oil industry right now, we're not going to tell you you can't succeed, but I think we all know the oil industry is retrenching, it's laying off people, companies are cutting back. It makes it much more difficult to succeed in a business when the business isn't doing well, versus if I have some new way of doing video conferences, well, gee, that's booming in this kind of marketplace. So market prospects are very important. Solvency, you obviously need capital to execute your plans. I've seen companies, have great plans, and I used to visit with companies say, oh, we're going to grow dramatically and do this and that. Then you look at their balance sheet and they don't have any capital to do that. Well, how are you going to be able to fund your growth? So you need money to be able to run your business on a long-term basis. That's solvency. Liquidity and efficiency goes back a little bit to the working capital comment we made earlier. You need money to run day to day. So if you're starting a business today, and again, Walmart's not going to pay you for 90 days, but if I come work for you, you can't say, well, Mike, come work for me, I'll pay you in 90 days. I'm saying, I can't handle it. I need to get paid sooner than that. So you need money to cover your short-term obligations. The landlord wants to get paid now. He doesn't want to get paid 90 days later. So that's what we refer to as liquidity and efficiency. And then profitability. What that means is for every dollar we generate by selling our product or providing our service, how much of that comes down to the bottom line? Are we making money? Is it worth our while? Is it worth our effort? And we'll talk more about all these in a second. So financial ratios. And there's a lot of ratios here, and I believe each of you will get a copy of the slide deck after this. And I'm not saying you need to pay attention to every one of these, but this gives examples of various ratios that are out there. And we'll talk more about some of these in a second that people use when they look at financial statements. It sort of goes back to my, why question, why is the current ratio this? Why is the debt ratio this? What is it? Why is it changing? So these are just some ratios. And again, we'll talk about, here, same thing on profitability side, gross profit margin. We talked about a little bit, sales minus variable cost gives us gross profit. And then, profit margin, net income over sales. And then return on assets, are we getting a return on our investment? I'm investing money with you, are you generating a return that it's worthwhile for you to do this? So this does give some example of a current ratio and quick ratio. Again, current ratio is just current assets over current liabilities. In this example, the number went down from 2011 to 2013. That's not good. That's not necessarily bad. The question you ask yourself is why? Where quick ratio is another similar ratio. It's just current assets minus inventory minus liabilities. And again, the ratio went down. Debt to equity. So here, debt, how much money you owe versus equity, stockholders' equity, the net worth of the business. This went down, which would be a positive sign. And the same with debt to assets, in this case, went up. And people very often ask, well, what's the right amount of debt for my business? And the answer is whatever you think is appropriate to manage a business, that you could pay your suppliers, pay your creditors, pay off your bank obligations, and run the business. There is no right or wrong answer. I used to see companies that wanted no debt. They said that they only felt comfortable with no debt. And there was other companies that had a lot of debt. The biggest risk, of course, of having a lot of debt is that business slows down. You may have difficulty being able to cover all your payments. So ratio analysis, profit margin. Again, we talked about for every dollar you sell, how much net income do you generate? In this case, the business generates 10.8%. So I have a trivia question for you, and obviously I can't see your hands, but ask yourself, who do you think has more sales, Kroger or Microsoft? Both are huge companies. I think both are doing well right now because of the pandemic. So which company do you think has more sales? And the answer is, last time I checked, Kroger. So Kroger has more sales. Which company has more net income? By far, last time I checked, was Microsoft. So for every dollar of revenue that Microsoft generates, they bring home a lot more net income than Kroger. And in some ways, that's not surprising. Let's face it, selling cans of Green Giant corn is not that profitable. It's not that difficult to do. We all could call up Green Giant and say, we want to buy some cans of corn and sell them in our local store. it's harder to add value in a grocery store. Where if we're running a PC, including this PC runs on Windows. If there's no Windows, I don't even know what other operating system there is out there. So Microsoft has a much more proprietary product. So their profit margins are much higher. I'm not saying Microsoft's a better company. I'm not saying it's a better stock. But what you need to think about in your business is, what are my profit margins? How do I differentiate myself from my competition? And how can I use that to an advantage to make my business more profitable? And that's one reason we look at our profit margin percentage. Return on investment, we talked about that before. Again, it's basically how much profit we're generating divided by either our assets or our equity being, the lower right-hand corner of the balance sheet. And we want to see if it's worth our effort to go ahead and generate this business, to start this business. I once had a SCORE client came to me and she was making jewelry and she said she's making money. I said, "Are you accounting for all the costs?" She said, "Oh yeah." I said, "Are you accounting anything for your time?" She says, "Well, no, I don't have anything in for my time." Well, her time has value. She can get a job elsewhere and get paid nicely. So you want to make sure that your business is generating enough of return to make it worthwhile for you as a business owner and as potential investors. So the bottom line, you should expect reasonable compensation for your work, as I just mentioned, because otherwise, it doesn't make sense for you to start the business and to risk your capital. So a return on your owner investment is really important. And you want to be able to grow the business. And I believe that is the last slide. So let's see if we have any questions. Yes, actually, someone asked my email. Thank you. I was going to give my email. My email, and each and all you are welcome email me, is m.davis@scorevolunteer.org. You may have some questions, either uncomfortable asking or think of something later. Again, m.davis@scorevolunteer.org. And so I encourage you, if you have questions, email me. Also, I would encourage you to spend some time at our website, houston.score.org. Really spend time browsing the library. And if you're thinking about starting a business or have a small business already, I cannot emphasize enough how you should get a SCORE mentor, at least one. We have people with a wide variety of skills. We provide free mentoring. As I say, you can come to 100 different mentors one time or one mentor 100 times. We are here to help you. And we have people with a lot of experience. And the worst come to worst, you waste an hour and say, "Gee, I didn't learn anything." I think that's highly, highly unlikely. I just think, that we could help you. So someone is asking if they can have access to this recording. I'm going to let Jim answer that.
Yes, we record all our webinars, and give us a week, and then you can go to our website, which is SCORE Houston. And of course, the top, one of the choices you have is take a workshop. You click on there, in the middle of that landing page will be a blue button that says download workshop notes and videos. If you click that, you'll go to a file that's chronologically ordered, and you have to look for the date. That's today's date. And next to it, you'll probably see something like financial statements. It's just a very short, brief description. And that video would be there to download. Give us about a week to get it up. We have another volunteer, of course, who has to do all that end of the business. And like all volunteers, it may take a little while to get it done. But we will have it up there in about a week. And if you really want a copy of the PowerPoint presentation, you can either send me or Mike. See, I got the name right, Mike. An email, and we will get you a copy of the PowerPoint presentation. This is not copyrighted or proprietary in any fashion, and we're more than willing to share it.
Okay, we got a few other questions, Jim. Monica asked about if there'll be more advanced webinars in accounting. I'm not sure necessarily we're going to do that. Again, we're not trying to make people accountants. We're just trying to make people understand the basics. It's possible we could do that. Again, I would encourage you, if you have questions, contact SCORE and say, "I need a mentor. I need some help with accounting." We'll be glad to help you. Potentially maybe answer your questions more specifically.
Okay. We had a class on bookkeeping on Tuesday of this week. Again, it was basic bookkeeping, and it went into general journals and other aspects of bookkeeping. And that in this course, both tee up a course that's coming up in December 1st on QuickBooks. which impact both financial statements and the bookkeeping issues. So in a way, that's a little bit more advanced. And we repeat all these courses, these basic training courses, every 3 months. But I don't think we're going to be getting on to more advanced courses in accounting. We may go into very specific accounting issues over time, tax accounting and a few other things. We have a tax accounting coming up in December. So there are very specific issues within the accounting world that we may be touching upon. And again, you just watch our SCORE bulletin board and you can see when those courses come up.
Okay, great. A few other questions. We have some really good questions here. So how do you calculate depreciation for items you purchased? That's an excellent question. So if I bought a car for my business today, let's say for simple math, I paid $25,000 for it. I would calculate depreciation. I'd ask myself, how long do I think I'm going to keep this car? Let's say I'll keep it for 5 years, and I think it'll be worth $5,000 after 5 years. So I'm paid $25,000. So it's worth $5,000 at 5 years. So that means $20,000 will depreciate by $20,000 over 5 years. So my depreciation expense in that case would be $4,000 a year. So simply you look at the value you paid for something, you ask yourself how long you think it'll last. You ask if you think, will it have any residual value? And those are guidelines which you use on how you calculate depreciation. There are some other methods where you take accelerated depreciation. I won't bore you with that. But basically, as part of it, it's what's it worth? What do you think will be worth down the road? And that's how you calculate your depreciation expense. Jason had a good question too. You know, how does one evaluate your time for services? So the lady who was making the jewelry, the question, you know, if she asked me, well, okay, well, how do I account for my time? What I would tell her is, if you had to hire someone to help you make the jewelry, how much do you think you'd have to pay them? If you pay them $10 an hour, 20, I have no idea what it costs to help someone make jewelry. But I would say that's one way you look at it. Not so much what else I get paid elsewhere, a different job. But if I had to hire someone to do what I'm doing, how much do I think I need to pay them? And that way you would put that into your cost structure, because it's very important you include that. How do you get a copy of the presentation? We talked about that. Thank you. Tax accounting is what I'm looking for. What do you recommend a life coach use to track financial when they are first starting a business? Low cost or free? I guess I'm not sure I understand that question. Track financial when you're first starting a business. I'm not sure I understand the question about low cost or free. Again, I would encourage you to contact SCORE, get a SCORE mentor, saying, I want to start a business. I need some help about setting up my financials in terms of, how I go about doing that. And then we could very easily help you with that. The last presenter recommended cash-based accounting. You recommended accrual. Again, there's no right or, that's an excellent question, by the way. There's no right or wrong answer. Most of the businesses that I used to look at, they were public companies, and most businesses that I know look at accrual accounting. It's not a question of one is right or one is wrong. You just need to understand the difference between the two. And more importantly, you want to be consistent. And if you're looking at buying a business or selling your business, you need to make sure that you understand the person knows what method you're using. How many years does it take to start seeing profit in business? We are construction subcontractors. The answer is no one knows the answer to that, but you should have some idea based on your cash flow projection. Because if you told me you were going to start a business today and you think it's going to take 3 years, I would say, is it really worth it? It may be worth it. I suspect people like Amazon took years before they started generating profits, and we know how that story worked out. But the key thing is you need to take into account, if you're not going to generate profit for 3 years, do you have enough cash to sustain the business? Because you may have a great business plan, you may have a great business idea, you may have great products and services. But if you run out of cash after 2 years, none of that matters, because it's not going to matter. So you need to make sure you take into account. But so there's no right or wrong number. One thing you realize when you talk to SCORE mentors, and also I've learned being a SCORE mentor is, we can't tell you the right answer. I can't tell you, well, your business should be profitable in 6 months, or your business should have a 40% profit margin. one, the marketplace tells you those answers. And two, the key thing is that you've thought about those kind of questions and say, well, what if it is this? Or what if it's not what I think, that I'm prepared for it? Next question. Oh, understood. Okay. Are there any changes for getting charges? No. I said this early on. Again, maybe what's amazing, what's great about SCORE is we provide free mentoring. And remember, I once answered the phone in the main office and someone said, well, that's great. What do you charge? I said, there is no charge. You get a SCORE mentor. What I said earlier, and some of you maybe heard me, some not. You could have 100 sessions with 100 different mentors. There's no charge. You could have or 100 sessions with one mentor, there's no charge. And now with virtual, you could have SCORE mentors all over the country. I actually referred a client to a SCORE mentor in Florida the other day who was an expert in a certain field. We are here to help you. So where do we get money from? In some ways, you're asking that question too. We get money from the Small Business Administration. We get money from various banks in town and other organizations. So, if I do a great job today, they're going to double my salary. So I go from 0 to 0. If I do a lousy job, they'll cut it in half. We are here to help you. We all have a passion about helping people like you. And that's why I cannot emphasize enough. You should get a SCORE mentor. There's no downside. It's only upside. I think you'd find it very worthwhile.
Mike, let me add to that.
Sure.
If you go back to the website that you used to register for this seminar, and you choose the button, Get a Mentor, it'll give you a form to fill out. And in that form, if you're very specific about the type of advice you're looking for, then you will be given a mentor who specializes in that field. Unfortunately, many times we have people say, I want to get into business, and they don't say much more, or they're very vague about what it is they're looking for. But if you're very specific, you will get somebody like Mike Davis if you're looking for a financial issue. So again, go back to the SCORE homepage for Houston, find a mentor, and be very specific about your need.
So another question someone had, a good question. We just hit year 2 and have a profit, which is great, but haven't been able to pay back our initial investment yet. I'm not troubled by that, but that's why you need to do a cash flow forecast, let alone a profit forecast, because you may be generating profits, but you may not be generating enough cash to pay yourself back. So you got to sit down, and again, SCORE could help you do a cash flow forecast going forward. Say, well, we're going to generate net income. Will we generate cash that we're able to start paying ourselves back? And if you're not generating enough cash to do that, despite making a profit, I would tell you that you need to raise your prices. And again, SCORE mentoring is free, and maybe the advice is worth what you pay for it. I don't think so. But I tell people, I have never, ever, ever told a SCORE client to lower their prices. But I've told many clients to raise their prices. So maybe you need to raise your prices. And I don't know what product or service you had, and that's not even that important, but you need to do a cash flow forecast and see if you're able to get enough cash back so you can recoup your investment. If not, you may need to raise your prices. And of course, people say, well, I'm going to lose some business. Well, yes, you will find some people that only buy the cheapest thing available. And frankly, those are not the kind of people you may want for clients. You're not doing this for the good of America. Hopefully you're doing it because you want to generate a profit, and you want someone that appreciates the value of the goods and services you provide. And so maybe you need to raise prices, but I would encourage you to sit down and do a cash flow forecast in conjunction with a sales forecast and see when you're able to potentially generate, cash for yourself. After you come up with an amount to pay someone to do, what do you do? How do you incorporate that amount in the cost of the job? Okay, well, I guess it depends on the kind of job, but if I was gonna, let's say, I was gonna, mow the yard of a very large facility, and I was gonna do it myself. Well, if I have to hire 2 other people to work with me, well, I know how much I'm paying them. So on top of that, I would need to account for, I need to buy lawnmowers for them. I'm gonna consume fuel. I need insurance for them. So I just need to make sure that I have all the cost involved. So, when I give a quote to the customer in that case. So just make sure you have whatever cost and profit and something to make it worthwhile for you in that situation. And again, SCORE could help you with that. Can also help to write a business plan. There's no question mark there. I assume it's a question. The answer is yes, we do. In fact, our website, we have templates of business plans in the library. And I know before Jim cuts in, I know he would say we offer workshops, many workshops on how to write a business plan, including one of our main workshops called Starting and Running Your Own Business. The plan is to offer it the second and third Saturday of every month. We do have a nominal charge for that, but it has a whole dedicated section on how to write a business plan. But I would encourage each and every one of you to write a business plan. And what I would tell you to do is, sit down, take a crack at it, spend some time, going through our workshops and also on our website, and then get a mentor. And then you could email the mentor or mentors your business plan, and we give feedback to you. And again, for free. So we could help you with that very much.
Let me answer that question there, Mike. If you've asked for a mentor and you haven't gotten any response yet, you actually will receive a note from one of our colleagues saying, have you had follow-up? It's usually about 48 to 72 hours after you put your request in. And if that request hasn't come in, I would reapply. For some reason, your name didn't register in the queue, because we do send out notices after the fact to those people who have asked and nobody's responded to them. So.
Okay, Cindy, you said your business is a repair and remodeling job. Again, in terms of including the cost of the various subcontractors, just sit down and say to yourself, what do I think all my costs are? Whether it be materials or labor or insurance, and then frankly, add a profit to all those. Because again, you want to make sure you're covering your cost and then some. So I think that was your question. So someone had a question. Very good, actually, about depreciation. What were the other non-cash items? I did not agree with the other non-cash items on the slide, so that's why I didn't mention them. But the big non-cash items are almost always depreciation. And then the oil business, you have depletion, where the value of wells goes down, even though they may not producing less. But depreciation is almost always the big non-cash expense.
And so is goodwill, writing down goodwill over time, which is...
Well, that's true, but I'm not sure. I think they may have changed the rules that the companies don't, amortize goodwill anymore. I'm not sure, but that's a good point also.
Okay.
Any more questions before we wrap it up? Again, my email, m.davis@scorevolunteer.org. If you think of something at 2 a.m, you could email me. I probably won't answer you then. But and I know I keep saying, but we are here to help you. I am here to help you. Check out our website, because there's so much information in the library, and really check out all the webinars we offer. We offer more webinars than ever, and with a lot of great speakers, with a lot of information, and 99% of them have no charge, so you can learn a lot. And we are here to help you.
I'm launching a poll now, and I'd like everyone there to answer the two questions that are asked. One is about this webinar, and the other one is asking about, do you need any assistance? And I'll give you some time to complete the poll. Let me add one thing, Mike, to what you were saying about putting in numbers for yourself as far as a cost. And that is, a lot of that depends on how you're legally structured. If you're a DBA or an LLC with an S-Corp filing, the bottom line falls to you anyway as income. And so whether you put yourself in as an employee or not, the money still come the same way.
Well, that's true, but I guess what worried me on the lady with the jewelry was, what if she, selling her product for X and thinking, okay, I really don't have much in for me, and then she goes, hires someone. Suddenly she realizes, gee, at this price, I'm not covering my costs anymore. I need to raise my prices. And someone asked again for my email, which I'll give, m.davis@scorevolunteer.org. And I see a few more questions. What else here? What's it? Mark, you want the slide deck? Again, email me and I'll be glad to, I don't have your email. Just send me an email, m.davis@scorevolunteer.org, and I'll be glad to, send anyone the slide deck.
And again, you can view the video in about a week on our SCORE website.
Isn't this a 2-hour workshop? I think we blocked out 2 hours. Just never know how long it goes. And, and plus we never know how many questions we have.
We put on some presentations. The questions go on as long as the webinar. Things like real estate and commercial insurance. People have an unending list of questions.
And frankly, we find sometimes that as we get long into the presentations, we start losing our audience.
Well, you had a good audience today, Mike. You had it up in the low 80s at peak, so that's good.
So I got a few more questions here, which I don't mind answering. How to understand and compare financial statements of companies when purchasing their stocks? Well,
Well, that's your
I guess
background, Mike.
that's right. Yeah, so that's what I spent my career doing. I guess looking at financial statements in itself is not the way you necessarily decide to buy stocks. But for example, if I were looking at Home Depot stock, one thing I might consider is looking at Lowe's is also public. So look at both of their financial statements, compare one to the other. Does one have higher margins than the other? Is one growing faster than the other? So again, there's no right or wrong answer, but just you could see potentially, if one's not doing as well as the other, on one hand, you could say, well, gee, I want to own the one that's doing better, or maybe I want to own the one that's not doing better because they can get as good as the other one. Where to find the cash flow forecast of companies I'm considering to purchase stocks? They're on their website. They're in Securities and Exchange Commission filings. They file every 3 months. They file with the Securities and Exchange Commission. So if you go to the company website, you would find them. I am starting an e-commerce. Do I have to have an LLC? I don't believe you're not legally required to have an LLC, and I am not a lawyer. The reason people want LLCs very often is if they're worried about liability. I don't know what service you're providing. The reason people have an LLC is to, yes, for the legal structure, but one big reason is to limit their liability. Can I go over a bit about understanding the equity part of the P&L? Well, equity is part of a balance sheet. So a balance sheet on the left-hand side has assets. On the right-hand side, we have liabilities. And the difference between the two, assets minus liabilities, it's called equity. It's called stockholders' equity, owner's equity, and sort of the net worth of the business. So again, it's, how much is the business worth if I, take all the assets, subtract what I owe. In fact, each and one of you is welcome to do a personal balance sheet. You could actually do this. It'd be a good exercise for you. List everything you own. You may have a house or a condo. You may have a car. You say, my furniture is worth this, or I have a great PC. Maybe you have a Rolex watch. I don't know. All the assets. And then, hey, I have a mortgage. I have a loan payment on my car. I have other, liabilities. And then sit down and you can see what your equity is. Can you put the email in the chat box? I guess I could do that. My business is consulting, relatively low overhead. With that said, will my financial statement or cash flow statement be thorough enough, as some of the examples showed? I think you should still look at financial statements regardless of your business. And in your case, your business is simple. You have low overhead. You have, you don't have a lot of cost involved. You don't have fancy machinery, but you still should do a cash flow statement and still want to look at financial statements because, again, you want to even see if your business is worthwhile doing. If it's worth the effort, if you're generating returns, just that it's a lot easier to do because you have less expenses and it's a very simple business. Where are the questions posted? I guess they're posted under the Q&A section of the Zoom call.
What, I mean, the polling questions, they should be able to see them on their screen.
Okay, yeah, okay, I don't know what that refers to. What's the difference between member draw loan and loan and from to shareholder? I guess I'm not sure I understand the question. Member draw the loan and from to stockholder. I'm sorry, I don't understand that question. You're talking about borrowing money from the business, as an owner. I guess I'm not sure I understand that. Sorry. Or if so, I mean, a member draw versus a loan to a shareholder. So if you have a business and you're making a loan to a shareholder, I guess the business is loaning money to a stockholder. I guess a member draw, I guess I've not heard that term before. I take it a member draw means, I don't know. I guess I don't know the answer.
Well, let me just add, from a tax standpoint, if the business is trying to loan money back to the owner of the company, the IRS looks right through that. It does not recognize it as a loan. And that ends the poll. So Mike, thank you very much. And again, you can get the video off our website in about a week. And if you would email us, one of us, and we will get you the actual PowerPoint presentation. And with that, thank you very much and have a great day.